Hey guys, welcome back to the channel. So in today's video, I'm going to cover how you can use the VIX index to trade SPY, but most importantly, how you can actually incorporate the VIX index into your trading and investing plan. Now, the volatility index, also known as the fear index, is referred to as the fear index or the fear gauge, simply because the VIX is a measure of volatility in the market. So a higher level of VIX represents a high level of fear in the market, and a low level of VIX indicates that there's a high level of confidence, which basically means that there's not much fear in the market. So the VIX, the way it's measured is its near-term sentiment by using options for the current month's expiration and the next month to calculate the VIX. Basically, the people that buy put options that hedge their portfolio, the put options are taken into account to calculate the VIX index. Now, when you're looking at options, you want to be a buyer of options when the VIX is low, and you want to be a seller of options when the VIX is high, simply because when the VIX is high, you're receiving more premium in return when you're selling the options. And when the VIX is low, you're buying options at a cheaper price, basically. So when the VIX rises, the premium goes up. Your option that you bought when the VIX was low also goes up as well. So it's simply just, like I said, when the VIX is high, you want to be a seller of options because you collect more premium. And when the VIX is low, you want to be a buyer of options because the options are relatively cheap. Now, how you can use the VIX to trade SPY. So when the volatility is likely to rise, as I said, options are likely to become more valuable and buyers tend to gain more, which is why you want to buy options when the VIX is low. And when the VIX is coming down, then there'll be more wasting of time value and option sellers are likely to benefit more. So that's when you want to be a net seller or a seller of options when the VIX is high. Now, on this chart, you can see the correlation between the VIX and the S&P 500. Anytime you see a huge spike, and there's only been two relative on this chart, but any little big spike that you see, you can see the correlation for the S&P is that the market comes down. When the VIX is basically flat, you see the market continues to soar higher. Anytime the market comes down, the VIX spikes. When the VIX is flat again, the market goes higher. These two big spikes are significant. Why? Because this right here was a financial crisis and this right here was the COVID crash. The COVID crash spike was actually the highest level of the VIX, in its history. So it's important that when you see these massive spikes that there is a lot of fear in the market, and you can see the market was in a clear uptrend. Yes, you have these little spikes that you can see here throughout the years, but again, the market does take hits anytime you see these spikes. If you just draw a line straight down, and this massive one, you can see this is where the COVID crashes. They said there was a massive downward pressure on the S&P 500. Now, when you look at the history of the VIX, you see here that the VIX index since the year 2000, basically the past 20 years or so, is about 20. So the average being about 20. So what does that say? Anything that's dramatically higher than 20, you can see that there's panic and fear in the market. Anything lower than 20 is basically an average day, and everything's going fine. There's no economic news. It's really hitting the or causing major headwinds. So everything's fine. It's just another day. But again, this is something to pay attention to, because whenever a news headline comes out that you may think is impactful to the market, that's how this is what I use. I look at the VIX index. If you don't see any significant movement in the VIX, it's basically a non-event. So these two major spikes again, the 08 financial crisis and the COVID crash in 2020, these are the highest in the past 20 years. These spikes right here did drive the market down, but the VIX can be traded. So you can just draw a line straight across and see that around 45 is resistance and around 10 is support. But again, the historical average is 20. So anything under that, you're basically on an average day. Anything higher than that is time to start looking at the market, determining what's driving that. So just to recap on this short video, the S&P 500, the SPY, and the VIX have an inverse relationship. They have a negative correlation. As the VIX spikes and goes higher, the market comes down because there's panic. There's, it's high volatility, and then it falls with the broader market. So a higher VIX indicates that there's fear, and a lower VIX indicates there's confidence. So in a sense, some people use the VIX to dictate when they buy and when they sell. If you own stock and the VIX is spiking rapidly, there's fear in the market. Sometimes, that's the best time to buy, when there's fear. And then the lower the VIX is that sometimes people get overconfident and too complacent, and that's the time to sell, when people are greedy. It is mean reverting, so which means over time it will return or move back to its historical average, which in the past 20 years is 20. So just like a moving average in a stock, it always comes back to the moving average. It's the same thing with the VIX. It'll always mean revert back to its average, which, like I said, is historically in the past 20 years is 20. The VIX cannot be zero. It's just impossible, because volatility is a constant. Volatility in the market always exists, so it's impossible for the VIX to be zero. And just to recap on the options perspective, when you correlate it to the VIX, if there is a low VIX, you want to be a buyer of options, because then options are relatively cheaper. If the VIX is high, you want to be a seller of options so you can collect more of that time premium. So hopefully y'all found this video helpful. This is exactly how I use the VIX. So anytime I hear a major headline that you think is going to drive the market one way or the other, just look at the VIX index. If you see a sharp spike, let's just say the VIX is at 17 and it spikes to 20, then you can see that, there is a little bit of panic in the market. And as it continues to go higher, you'll see the market take a hit as well. And if the VIX is just flat, under 20, it's just basically another day. And so anytime you want to determine, like I said, the market and overall investor sentiment, just look at the VIX index, and it's an extremely helpful tool that, like I said, you can implement in your trading plan and your investing strategy moving forward. So I hope you all found this video helpful. If you do, drop a like on the video, subscribe, leave me any comments if you have any questions. But if not, thanks for watching, and I will catch you on the next one.